Hi, and welcome everybody to 3 COVID-19 relief regulations, impact to your benefits and the bottom line. My name is Dan Kuperstein. I'm our SVP of Compliance here at Corporate Synergies. I'm joined today by Pam Smith, our VP of Account Management, based in our New York office. And we're both really so happy that on behalf of myself and Pam, really, we're both so happy you could join us today for this discussion. Today, we're going to be taking a close look at how 3 impactful COVID-19 relief rules work and how they could really impact your health and welfare plans, renewal and claims experience in 2021. And of course, how this could impact your budgets and your bottom line. And additionally, for each of these 3 rules, Pam and I are going to be discussing some real world examples of risk reducing strategies that your organization can take now to reduce your exposure to liability and to prepare yourself going forward. So additionally, I just wanted to say, first of all, to start us off and to quote the classic TV show Dragnet, well, everything that you see, everything that you're about to hear is true. The names of the clients have been changed to protect the innocent. So just wanted to give that disclaimer because I am the attorney in the room, and that's basically what I have to do. So we'll be taking a closer look at each of these 3 rules, and of course, breaking down some key takeaways for you that you can use going forward. Okay, so let's start off with, I'm going to give a little bit of background before we go into those examples. Let me just give a background on the COBRA subsidies under the ARPA, which has been a hot topic of conversation amongst our clients. So the ARPA, or the American Rescue Plan Act of 2021, was this major COVID-19 relief law. And within it, it provided that there will be 100% COBRA subsidy that would be provided for coverage during a time period called the ARPA subsidy period, which is from April 1st of 2021 through September 30th of 2021. And during that time, the COBRA beneficiary would not be required to make a premium payment. The employer would be making the premium payment. The premiums then would be reimbursed to the employer through a refundable payroll tax credit. Now, I say employer, we're going to be talking about employers today, but there are some circumstances where the plan gets the credit if you have a multi-employer health and welfare plan, typically referred to as a union plan. In those cases, the plan would get the credit. But in almost all cases, for a fully insured or self-insured plan, the employer is going to be getting the tax credit. Now, this time period would not extend a normal COBRA continuation coverage period. And in order to receive the subsidy, you have to be what's called an assistance eligible individual, or AEI, which is generally someone who had a COBRA event that was either an involuntary termination of employment or a reduction in hours, regardless of whether that reduction in hours was voluntary or involuntary. And you are not eligible for the subsidy if you're eligible for coverage under another group health plan or Medicare. And the qualified beneficiary is required to give notice. This AEI, who is taking advantage of the COBRA subsidy, is required to give notice to the employer if he or she is no longer eligible, because he or she becomes eligible under another group health plan or Medicare. And really, this whole process, this whole program under the ARPA, as we talked about, I think in a lot of our other webinars in the past, is very similar to a law that came out in 2009, which is the American Recovery and Reinvestment Act, or ERA. Back in 2009, the ERA was designed to help people by providing subsidy assistance during the Great Recession. And in many ways, this law is really kind of based on that law, and it looks almost exactly the same, uses a lot of the same terms. And so that kind of gives us a little bit of understanding of how this works. And here's a little more of an in detail definition of what an AEI is, right? Those who had this involuntary termination or reduction in hours that occurred either during the subsidy period, prior to the subsidy period, but they have an existing COBRA coverage extending into the subsidy period, or prior to the subsidy period and they have not yet elected COBRA, but if they would have elected COBRA and that COBRA would have extended into the subsidy period, including those who elected and subsequently dropped that COBRA coverage, they would be eligible for what's called a second election period or an extended election period under these special rules to get a COBRA subsidy for that time period of April 1 of 21 through September 30th of 21. And also this includes spouses and dependent children, even if the employee does not elect COBRA. And then so there were several notices that were issued by the DOL on April 7th of 2021 that explain how, employers are supposed to give notice of this, and this happened, was supposed to happen before May 31st. And basically, you give notice to your employees about these special rules, and there's other options available as well. You can also allow them to have to elect other coverage at your option. It's an optional rule, and generally speaking, there's all kinds of different things you can do with regard to these, with regard to how you want to set it up. But really, one of the key features here is that there's the summary of COBRA premium assistance notice. What you see is that last sub bullet there, where there's a form that an employee can fill out, a self-attestation form that where the employee attests to the fact that he or she does not have other coverage and is not eligible for other coverage and is an AEI, and all of those are available at this link here. Now, what was clarified in the April 7th guidance that we received along with these model notices were basically how the penalties work. So there is this $250 tax penalty that applies if you as an employee fail to notify your employer that you're eligible for other coverage and you're getting the subsidy period. And then there's some if it's an intentional failure, then of course it's a little bit higher of a penalty. It's either the greater of $250 or 110% of the premium assistance received after you're no longer eligible. And then of course for the employers, there's a penalty as high as $100 per day per qualified beneficiary, but not more than $200 per family for each day of noncompliance. And obviously $100 a day, $200 a day, those are big penalties if the employers don't get this right, if they don't do the notices correctly. And then of course, there are tax rules that apply here. There's specific rules about how to take out the tax credit and things like that were more recently given to us from the IRS, as well as, most importantly, I think for our clients, one of the biggest questions that we received on all of this guidance that came out was, well, what is an involuntary termination of employment? And you would think, of course, right, that would be something that kind of would be said from the very beginning, right, from the outset. This is what an involuntary termination of employment is, but it wasn't defined until, as recently, May 18th of 2021. And we're recording this today on May 26th of 2021. So it's really only been, that was really only about a week ago. And so a week ago, IRS clarified what that definition was and said it's really going to be looking at all of the facts and circumstances that surround that, and then gave some very helpful definitions of what is and what is not involuntary termination of employment. And we'll look at that and on this next slide. I'll give you some examples. That was extremely helpful because before that, a lot of employers were looking at the ERA rules. Remember those 2009 rules, trying to figure out, well, how did the ERA define it? And in fact, the ARPA, the new law, defined it exactly the same as the ERA. So that kind of made it a little bit more clear. And generally, in plain English, that definition basically says that, if an employee is, if an employer is terminating the employment and the employee is still willing and able to work and wants to work, then that would be an involuntary termination of employment. It's a lot more fancy legalese than that, but that's the gist of it. And then, of course, this guidance that came out on May 18th also explained how an employer retains documentation about who is an AEI, who is not an AEI. It talks about the eligibility for how eligibility for an enrollment in other coverage affects subsidy eligibility. And a key crucial rule that came out here was the fact that if you are in a waiting period for coverage and you may be eligible for other coverage, but you're in a waiting period and you can't actually be enrolled in that coverage, you are still eligible for the subsidy, which is a very, very helpful clarification that was not received in prior guidance. The guidance also clarifies that the subsidy is available for vision only and dental only coverage and HRAs. Does not tell us about certain other plans like EAPs, but generally speaking, all group health plans, with the exception of health FSAs, are subject to the subsidy rules. So it's extremely broad in scope. And then, of course, another interesting wrinkle in all of this is that this guidance clarified that the ARPA extended election period applies for getting the subsidies to employers that are no longer even subject to federal COBRA if employees experience an involuntary termination of employment or reduction in hours while subject to federal COBRA. So in other words, you could be a very large employer and because of the pandemic, you have a furlough or layoff or whatever it is, you are no longer subject to COBRA. But at the time that layoff occurred, and you were subject to COBRA, those employees would still be eligible for the COBRA subsidy. Now, we should also mention here just briefly that there were additional rules that say that that allow individuals to be eligible to receive the ARPA subsidy if they were on a continuation coverage period from a mini COBRA law. Now, mini COBRA was never defined, in the guidance, but generally is understood to be those laws that are provided by state law that allow for employers who are too small to be subject to federal COBRA to have continuation coverage, which my understanding is that there's 35 states that have that out of the 50. So most states, there is a mini COBRA law that could apply if you're too small to be subject to COBRA. The guidance also explains the overlap between ARPA and the DOL's and IRS's outbreak period rules, which we're also going to talk about a little bit later because those are important to this as well. And the key thing there is that the outbreak period rules essentially give you a 1-year time period where they pause compliance deadlines. So you would have an additional year if you had to elect COBRA, you'd have an additional year to elect COBRA. If during the while there's still a national emergency in the U.S. And that essentially would pause that deadline for you. And the one thing that's clarified here is that you don't get an additional year to elect the ARPA subsidy for that COBRA, but you still can take advantage of those rules for regular COBRA. And then of course, if you're on regular COBRA, then of course you would be eligible for the ARPA subsidy. But these rules make very clear that you can't use that 1-year period just for electing the ARPA subsidy. There's also some special rules in here about how, to clarify that you can add spouses or dependents under the ARPA extended election period, and it explains some of the details about how employers go about collecting the premium tax credit. Now, interestingly, for our purposes, like I said, one of the big questions that we were getting from all of our clients was, well, what is an involuntary termination? How does that work, right? Because that's so central to deciding who are these people who, could have been in a COBRA continuation coverage period when that ARPA subsidy period happens. And so these are some of the examples here on the slide that are considered to be involuntary termination. So termination for cause or just cause termination is considered to be an involuntary termination, with the exception of gross misconduct, which we generally advise that if the termination, if you're going to go that route, to really exercise caution, be careful, because that's a very, very high standard. So gross misconduct requires something very egregious happening in the workplace, something like workplace violence. Some of the examples that have been upheld by judges are, dealing drugs, on the job, when that's, and I'm not talking about a pharmacist who's, doing his job, but, things that are really very bad. So that's an exception, but that also applies for regular COBRA as well, not just for the ARPA subsidies. So in other words, if you're doing gross misconduct, you're not going to be able to get COBRA anyway. Some other examples of involuntary termination of employment are termination of the employee while he or she is absent from work due to an illness or disability, and where that employee is expected to return back to work after the illness or disability subsides. A resignation as a result of a material change in the employment relationship that would be analogous to a constructive discharge, as well as an employer's decision not to renew an employee's contract if the employee was otherwise willing and able to continue the employment relationship, and was willing either to execute a contract with terms similar to those of the expiring contract or continue employment without a contract. However, by contrast to that, if it has to do with the expiration of a contract that was for a set term and very specified terms and conditions, where the parties to the contract understood at the time that they were contracting that it was not to be renewed, right? That would not qualify as an involuntary termination of employment. And then, of course, some examples of things that are not involuntary termination of employment. We talked about gross misconduct. Also, death of the employee is not involuntary. An employee-initiated termination because the child is unable to attend school due to a COVID-19 emergency, as well as retirement of the employee, except where the employee was willing and able to continue employment and had knowledge that they would be terminated absent the retirement. So that would also include things like buyouts and severance packages, and where the buyout or the package is provided as a way to incentivize that employee to retire earlier than he or she would have. So that's some of the helpful examples that we got on this most recent guidance, and that was just a huge help for what we do. So now that I've laid out all the groundwork here, I'm going to pass the microphone just to Pam. We can obviously keep this all very conversational, but Pam is going to give us talk a little bit about sort of how this affects the bottom line, how this affects renewals, for your account, and give us some real life examples. So Pam, why don't you take it from here?
Perfect. Thanks, Dan.
Sure.
So now that we understand the rules, what do we have to be concerned about with regard to our bottom line or if there's any financial risk for our clients and plan sponsors? So what do we know? So prior to ARPA, insurance carriers report approximately 1% of their membership on COBRA. And the claims costs for those COBRA members were traditionally about 150 to 250% higher than non-COBRA, which makes sense. You're paying for COBRA, you're using the plan. What carriers anticipate as a result of ARPA is about a 25 to 75% increase in the enrollment, given the fact that that COBRA coverage is now subsidized. So in comparing and contrasting to what we do know historically, which is what happened in 2009 with ARA, ARA provided a similar subsidy at 65%, not 100%, and approximately 34% of eligibles received the subsidy. So an increase in COBRA enrollment. Among the eligible individuals who didn't elect COBRA, 80% said it was cost prohibitive, even with the subsidy. So we're not going to have that in this situation with the 100% subsidy. Approximately 50% of eligible participants were unaware that they had the COBRA subsidy eligibility. So that's a possibility with ARPA, that you take the letter that comes from your COBRA vendor and you didn't read it, you didn't understand it. And then we also know that in the past, in 2009, participation rates were highest among individuals with higher incomes. So that also makes sense, since there was still a cost to the COBRA coverage. So, the anticipation is that, certainly there will be a rise in COBRA members with the subsidy. And what does that financial risk look like? So here's some key considerations to consider. 100% subsidy could potentially narrow the historical cost differential, so that 150 to 250% of what an employee on the plan costs versus a COBRA member could substantially reduce, because with the zero cost to COBRA, we should get more individuals to spread the risk, more that are not using the plan to that extent. Impact of plan design. So this is important, because if you're offering a high deductible health plan, the employees still have the deductible to meet, or the COBRA participants still have the deductible to meet before the plan is paying the cost. So depending on your plan's plan structure, that could impact the claims to the claims for the COBRA participants. And then, unlike ARA, the conclusion of ARPA, the COBRA subsidies triggers a special open enrollment for the exchange coverage. So, that could significantly impact the numbers of people that stay on COBRA after September, after the September 30th deadline for the subsidy. Employers should also be aware of how many employees are eligible and how many have accepted the COBRA coverage, reporting from your carrier on the invoices or reporting from your TPA, your COBRA vendor. And you'll want to monitor the COBRA claims, if available, closely during the subsidy period. Well, many of the same considerations apply for fully and self-funded plan sponsors. Some of the impact is a little bit different. So if we take self-funded plan sponsors for a minute, they're going to get the self-funded plan sponsors will get the tax credit for the full premium cost, the COBRA equivalent rate of the plan, but that's not necessarily the true impact to the cost of the cost of the claims for the employer. So so that's something to definitely consider. The employer will be able to take a tax credit for the COBRA equivalent rate. On a fully insured basis, the employers will get reimbursed for the full cost of the premium, but higher claims in that respect. So there wouldn't be an immediate impact. You'll get reimbursed for your COBRA, your premiums, but the impact could mean a higher renewal if your COBRA participants incur more claims. So what does this look like in regards to some employee situations? So real world examples of some things that we've seen. Client situation number one is restaurants and hospitality, which we know have had a major change and shift with the pandemic. So the client had a large number of ACA defined variable hour employees, most of which had reduced hours during the pandemic. Many were laid off and terminated. ACA full-time eligibles are eligible for the client's group health plan. So as the locations are opening, clients rehiring many former employees, but still reopening, more slowly. Employees that might have been full-time employees or might have been variable hour employees who qualified for full-time benefits in the past are now being hired again as variable hour employees. And what is their situation? So actually, those employees can still be covered under the COBRA subsidy, because if they're being measured as variable hour employees, they have not actually, under the May 18th clarifications, they're in their waiting period or their measurement period. They have not actually been offered an offer of coverage as of yet. So they're able to claim the COBRA, the 100% COBRA subsidy. Second real world example, seasonal employees. So this client has a self-funded health plan, and they have seasonal workers. So with that seasonal worker population, seasonal workers have been offered COBRA, in the past for the months that they do not work. And seasonal workers under the May 18th clarifications may be considered, and I underline may be considered involuntarily terminated employees, and those would be eligible for the COBRA subsidy. But we're going to have Dan weigh in here a little bit, because really it depends on the contract that the employer has with the employees, and I think it's important that we make the distinction.
Yeah, that's true. Yeah, so that's a great point. I mean, I think one of the interesting things is that even though the new guidance didn't really go into a lot of detail on, didn't really explain the specifics on seasonal workers, I think if you look at some of the examples they gave, they could fit, into the guide. They could fit into the guidance. So, for example, if you have a seasonal worker who has a contract, now if the contract is sort of up to the employer to determine if it will be renewed or not at the end of that term of that contract, and the employee is still willing and able to work in hopes that it gets renewed, and the employer has that discretion, but then decides not to renew that contract when the employee was able to work, right? Under those types of circumstances, right, that would be an involuntary termination. But under the other set of circumstances where you have an employee who contracts for a very specific period of time that is just for that particular season, and it's very clear when those months are, and then it's known at the time that they're contracting that the employee will not be working after that period of time, and it's designated in that agreement, right? That meets the sort of the opposite situation where it would be a voluntary termination of employment. So you really do have to look very closely at the facts and circumstances under this new guidance that we just received. we're going to assume for this purpose, I think that, which I think is in most cases, right, that these individuals are going to be involuntarily terminated. And I will say that I think that's the safer way to go, because I think in most cases where you have seasonal workers, in many cases, right, it's kind of like up to the employer to decide kind of when the season ends, or, they may point to some external circumstances, but essentially they're usually, those employees are usually still willing and able to continue working at the end of the season. And if there's no agreement in place about that, then I think you can kind of just assume as sort of the safe way to go that it probably was an involuntary termination.
So assuming in this situation, these would be involuntary terminations, the self-funded employers really want to understand the historical COBRA elections of that population and the claims of that seasonal population. And then, as we mentioned before, the risk pool with allowing more employees into the COBRA population with these 100% subsidy, may actually help a self-funded employer in that, they would be able to get the tax credit for a larger number of individuals to spread the risk should there, should they normally in the situation of their seasonal workers have a higher percentage of claims from COBRA eligible employees or employees who took COBRA. Okay. Early retirement incentives. So another interesting situation under ARPA and for COBRA subsidies. So this client offered early retirement packages to a group of employees and with incentives to retire early. These early retirees are considered to be involuntarily terminated employees and would therefore be eligible for the subsidy. So self-funded employers should understand the historical, medical, and pharmacy costs for the early retiree population to assess any immediate risk. Fully insured employees should understand that if there are additional claims costs associated with continuing to cover this group, it may impact their renewal. One thing to definitely sort of remember with this group is anybody over 65 has an offer of coverage through Medicare and would not be eligible for the COBRA subsidy.
Yeah, that's a good point. And I think with these types of things, what I think the industry used to call VRIPs, or voluntary retirement incentive packages. The key is really, is it an incentive to get that individual to retire early or earlier than they normally would have, right? That would not necessarily be the same thing as let's say an executive who, voluntarily decides to resign to spend time more with his family or to take care of a sick family member or something like that, and where they just, as part of their executive comp agreement or something like that, get some kind of payout package, right? So, but I think in 99% of the cases out there where there is some kind of sort of big incentive package or VRIP or buyout package, it is going to be used as an incentive for that person to retire early, and it will be considered to be an involuntary termination. So great, thanks. Why don't I go ahead and talk? Thanks, Pam. Why don't I talk a little bit about kind of how this, so the outbreak period rules, kind of how this overplays in real life with the COBRA ARPA subsidy rules. And I think this is causing a lot of confusion out there for clients, because they speak with their COBRA administrator and as well as FSA administrators and TPAs, and they're saying, well, you need a notice for the outbreak period rules, and you also need a notice for ARPA subsidies, and they're just like, why all the notices? What do I have to do here, right? And so we thought we'd just give some background on the outbreak period rules and kind of how that plays into everything. So if you can remember all the way back to May of 2020, the outbreak period rules were issued as part of an IRS and DOL joint notice, 2020-01. It was guidance that was essentially creating a pause period, a period of time that they refer to as the outbreak period, that would extend beginning with the president declared national emergency period, which started on March 1st of 2020, and would continue until 60 days after that national emergency period ended. And during that time, compliance deadlines would be paused. Now, there was this language back in that notice from 2020 that said, okay, this can only extend for 1 year under this ERISA Section 518 and Code Section 7508AB. So basically, this thing would end in a year is how we all interpreted that. At least most people were saying, well, this should be over by March 1st of 2021. But just when we were all kind of thinking that, the DOL said, not so fast, and came up with, literally, I think it was like 2 days or a day before the deadline of March. I think it was like the last day of February, or the day before that, issued guidance that said, okay, in this IRS notice 2021-01, clarifying that, okay, instead of applying the 1 year limit, for the whole year of March 1, 2020, we're going to be looking at this on a, person by person basis, participant by participant. And so the pause period will pause that individual specific deadlines for a 1 year period. And that pause period or outbreak periods, pausing essentially, or tolling is the technical legal word for it, would now be until the earlier of 1 year from the date the participant was first eligible for relief, or 60 days after the announced end of the national emergency period, which we are not. We are still in the national emergency period. So as of now, we just sort of essentially have to kind of assume that's going to probably continue at least for some time. And so, this clarification that it was on a participant by participant basis, it did kind of mess up the FSA vendors and FSA administrators and COBRA administrators out there, because all of a sudden they had to kind of figure out, well, how do we, administer this? And so the guidance kind of gives you sort of some practical examples and tells you how to do this. So the easiest way to do this is you identify the original due date for a particular deadline, but for the outbreak period, or the national emergency period plus 60 days, and then you add 1 year. So for example, and we're going to look at some examples here. I'll just, for the purpose of time, we'll just do example 1 and example 3. So example 1 is before the March 1, 2020 national emergency. We're going to take Sarah. Sarah has a COBRA election period that starts on February 1st of 2020. Her outbreak period's pause period begins when the national emergency period begins on March 1 of 2020. And at that time, she still has, she's used 29 days of her COBRA election period, and she has 31 days remaining. So there's just 31 days as a balance. And then the 1 year pause period goes into effect, right, beginning March 1 of 2020, and goes all the way until February 28th of 2021. And then her election period begins to run again for her COBRA election period. So now she has that balance of her 60-day COBRA election period, which we just said was 31 days remaining, right? So she has 31 days after March 1st. So she has, until March 31st as a dedeline to elect COBRA. So that's kind of how it works. It kind of just puts a big pause on everything for a year. Now let's look at example 3, which happens after, in 2021. So Sophie's COBRA election period starts on April 1 of 2021. And so her pause period begins immediately on that day. And her 1 year pause period would end 1 year from now, assuming, of course, that the national emergency period is continuing into 2022. Her 1 year pause period would end on March 31st of 2022. And her election period would begin to run again on April 1st of 2022. So she would have 60 days then to elect COBRA, and she would have to elect by May 30th of 2022. So the key, of course, there is we don't know if the national emergency period will be going that long, but assuming it does, that's how it would work. So that's the basics of how the rules work. Pam, do you want to give us some examples of kind of how this plays out on the budgets and the bottom line?
Sure. These rules give employees a really long time to make elections and exercise their rights under the plans. Particularly for COBRA, really they have the ability to use hindsight to make their election decisions. So I used the plan, I didn't use the plan, and now I'm going to decide I used the plan enough that I'm going to decide to elect the plan. Granted, the person would have to pay back premiums, but it does give that individual a hindsight decision. Employees and their insurance carriers, need to communicate all the claims decisions, elections. So this really falls into the bucket of impact in administration and what you need to do in order to inform employees and administer the plan the way you've decided to administer. So and then it's also on an individualized participant by participant basis. So so that adds complexity. And really, what we see here is a shift in control of the financial risk. The rules were created for, for the financial risk to be more in the favor of the employee, and then, now, changed to really it was originally more in the favor of the employer, and now really more in the favor of the employee. So, in the example that I used on the hindsight with COBRA, this could create a substantial risk claim-wise to employers if former employees, COBRA participants are allowed to have that long of a look back before deciding whether to elect the plan. And then again, back to administration, sort of the high cost of and administrative burden with regard to providing notices. So it's costly. And it's something that our clients need to be considering along the way with regard to the decisions that they're making on the on the outbreak period rules. So a real world example for us. A client situation is a construction company client and an employee. The employer sponsors a self-insured plan. The client has as an employee that has extremely high claims costs on the plan due to a back injury. The employee loses eligibility for the health plan due to a reduction in hours, which we've seen over and over again during the pandemic. And that person's COBRA election period starts February 1st of 2020. The injured employee missed the deadline to elect COBRA under the plan, but calls their human resources department on March 15th of 2021. And then says he wants to retroactively elect COBRA, going back to his termination date of 2/1/2020. So the HR department calls Pam and Dan and says, what do we do? So really, this kind of goes back to slide 18, where we had the examples. And this individual was eligible 2/1. They had 30 days under their original 60-day election period, because 2/1 was prior to the 3/1 pause period start date. So they used 30 days of that the original 60 days. 3/1 starts the pause period. 3/1/20 forwards to 3/1/21, and then that individual has actually 30 more days to elect the plan after 3/1/21. So that 3/15/20 date, what they called HR, they actually still have 15 more days to make that election. However, that person is going to have to pay retroactive back to 2/1/20 in order to reinstate their coverage. So that's definitely something to consider. Although actually in this situation, then ARPA came in and allowed, as of 4/1/2021, the subsidy. This person had a reduction in hours, and so they would be an involuntary termination or a loss of coverage, and they would actually be able to use the open enrollment, the COBRA open enrollment, to be able to join under the subsidy 4/1 and have 6 months of COBRA. At that point with the subsidy.
Right. And just to clarify, it didn't actually matter in this case if it was involuntary or voluntary, as long as it was a reduction of hours, and he would have been eligible during the ARPA subsidy period. It was within 18 months. So in this case, it didn't really matter. Now, it also didn't matter at the end of the day, because actually it would have mattered, I'm saying, if it was an involuntary or voluntary reduction of hours, but would actually the good result here at the end in this real life example was that the HR department let us know that the individual was not able to pay retroactive COBRA premiums to go back that far. And the main concern that the employer had was, of course, the big claims risk. So they were happy that that was the result. At least for that larger period of time. All right. So I want to talk a little bit briefly here about the FSA relief that happened as a result of the Consolidated Appropriations Act of 2021, or CAA. This was elective and temporary FSA relief for both health FSAs and dependent care FSAs, or DCAPs for short. And basically, there were 5 main rules. Each of these were voluntary or optional for employers who wanted to take advantage of this relief, but there was no requirement to do this. So employers could have done, as one of these, a carryover to the following plan year of unused DCAP FSA funds for plans ending in 2020 or 2021. There was also an extended grace period of 12 months for plan years ending in 2020 or 2021. There was a post-termination health FSA spend down, which allowed you to spend down following termination of participation in calendar years 2020 or 2021, and a temporary expansion of the eligible DCAP dependent age through age 13. Prior to that, it was to age 13. Now it's through age 13. And then there was a FSA election change in plan year ending in 2021 without a change in status events that allowed you to make mid-year election changes to health FSAs or DCAP FSAs without having to have a qualifying life event. Now, to amend the plans, amendments can be adopted until the end of the first calendar year beginning following the end of the plan year for which the change was adopted. So there's a lot of time to make those amendments, but you have to really be, kind of still thinking ahead, because you want to be, as soon as you are, adopting it, you want to make sure you're acting in compliance with whatever language you're adopting. Okay, so then we got some guidance from the IRS clarifying how some of this would work. There was no cap, for example. We thought there might be some kind of cap initially, but there was no cap on these carryover amounts, which we'll be talking about in just a little bit. And then carryover does not reduce the amount that can be elected in the subsequent year. And then, of course, the carryover amount doesn't count in the subsequent year's non-discrimination testing for their cafeteria plans under Section 125 or for DCAPs under Section 129. So that was very good news. And then the IRS did issue some additional guidance here about giving a lot of flexibility for employers as to how they want to set up these voluntary, optional choices for their FSAs. You could require that an individual be a participant in the subsequent year to get the carryover. You could require a certain minimum participation level, or you could actually set a maximum carryover amount if you wanted to as the employer. You could impose a limit on the months of the carryover, or even permit the carryover on the health FSA, but not the DCAP FSA, or vice versa. So the employers the IRS gave employers a lot of flexibility as to how they wanted to implement and administer these rules. And then there was also rules that came out making things even more flexible. Some guidance that came out after that, which allowed for prospective changes without, in health and FSA DCAP elections. There was an extension in IRS Notice 2021-15 that extended this relief to health plans, including medical, dental, and vision coverage, to make it consistent with this. So if you wanted to create a mid-year, essentially a mid-year open enrollment event, essentially you could do that with your health plans. And then, of course, employers were considering, employers could impose restrictions on all of this. But of course, there was a limit on prospective FSA reductions could be no lower than the amounts of benefits already paid. And then there are obviously some limitations for non-calendar year plans that had a shorter period to allow the changes. So there's a lot of rules that came out. And then one of the big things that happened was in March, the ARPA, the law we just talked about, the COVID relief law, allowed for employers to increase the annual limit on contributions to DCAPs to $10,500 annually, when the normal maximum is $5,000. And that was just for the 2021 plan year, which of course led to a lot of questions about what they should do and what the tax implications would be for that. And unfortunately, quite recently, we received guidance in Notice 2021-26 explaining what the tax implications would be and clarifying that for calendar year plan years, the amounts that would be available under either an extended claims period or a carryover provision that would normally have been excluded from employees' income that would have been excludable from employees' income. I mean, if they had been used during the tax year ending in 2020 or 2021, will remain excludable if used for dependent care during the following tax year. But unfortunately, this does not apply in the same way to non-calendar year plans. And if you look at this example, this is just straight from the guidance, basically. What happens is if those claims, if let's say you have a non-calendar year plan year starting in 2021 that goes into the 2022 calendar year, the amounts that go into the 2022 calendar year will not be, I'm sorry, this is the calendar year plan example, which we just talked about, but this is the non-calendar year plan example. And so the amounts that are incurred in the 2022 calendar year will be included in the employee's gross income and wages. So it's still not very favorable for those non-calendar year DCAPs to elect to allow for that maximum $10,500. At least it's not as favorable to their employees if you have a non-calendar year plan. So all of this, when you look at all of this together, all of this temporary FSA relief, some of the big considerations for employers are, should amendments be adopted, right? How many participants would be impacted? What are the impacts on HSA eligibility because of what we call stacking rules, right? If an employee is eligible for, health FSA, they would not be eligible for HSA. So, if a lot more people are electing into FSAs, is that going to impact their HSA eligibility? You have to look at the timing considerations, when you communicate these changes, when you communicate a special enrollment period, if that's what you're going to do. And then of course, if you have a self-insured plan, can your TPA handle these changes? I think that was a big concern. There's so much variation that's allowed and permitted under this guidance that I think for some of the smaller FSA administrators and TPAs, it would be very, very difficult for the TPAs to kind of handle some of the very sort of customized arrangements that employers wanted to do. So that being said, that's the big picture view. Pam, you want to talk a little bit about some of the financial implications?
Yeah, absolutely. So the impact on the budget and the bottom line here is, sort of less extreme with than sort of our COBRA discussion, but really, there's a huge impact on your time, on the time of all of our partners in HR. So, as you can see, there was as many slides on the FSA as there was on the COBRA, lots of different options and a lot of time to administer and communicate to your employees. So, I think that number one needs to be stated. And then, with regard to, how do we manage that? So if you take your FSA administrator and you run a report, you can clearly show how many participants will benefit from making one of these decisions. So, what's the impact? How many, what do you have as far as current elections and expenditures? Perhaps rolling over the FSA is only going to impact one or two employees, and then, then you can make a decision on whether or not the administration for that is something that you want to commit to, or you might find that, wow, this rolling over the FSA is really going to help a lot of our employees, and then you feel good about making that decision and spending the time to administer it. So I think number one, running that impact report to see which employees or how many employees are affected. And then, the cost of for the financial piece, the cost of the plan with regard to forfeitures. So, you have, during the year, you have employees that terminate and might have spent more than their elected amount. If, and in the past, that would balance out with the use it or lose it. And for employees who lost amounts that weren't able to be rolled over, if you're considering electing a full rollover, there will won't be an offset there on the forfeitures. So that's also something that can be assessed by running an expenditures report on from your FSA administrator. And then at least you'll have a known, or a pretty well known on what that impact might be for loss forfeitures. And then on the third piece, is important to understand the Section 125 discrimination testing. So if you've failed your for example your DCAP administration testing year over year, perhaps the increase to 10,500 isn't something that would benefit your employees if they're not going to actually be able to receive those that increase in DCAP tax free. So another consideration when making your decisions on how to spend your time. So with regards to the FSA relief rules, here's another real world example. A medical provider client that sponsors a self-insured plan, historically high utilization of both dependent care and health FSA benefits, but not during the 2020 calendar year. They weren't able to spend their funds. So the client's HR and benefit department has two individuals. Their FSA administrator is new and relatively small without the experience to run a lot of the new options. The client really wants to offer a full FSA relief across the board. So they want to permit everything. So what should they do with unlimited mid-year elections, no caps, no limit on days to make a mid-year election? So I think here, they call Pam and Dan and say, what should we do about this? And really it's a conversation. So, and every employer will be a little bit different in how they want to handle this. This employer felt really strongly about offering all of these opportunities to their employees, and they, based on the reports, it would impact a large number of their employees. So here it's really important to assess your goals, what's important to the organization, to work with corporate synergies and your plan administrator to come up with a plan that's functional from an operational and compliance perspective, and then to work together to execute the plan. So that including sort of thoughtful ways of communicating to employees, because if you're going to spend the time to open this up to your employees, then you really want them to understand that the opportunity that you've given them. So we have all different situations with regard to what our clients want to do in this situation. Some have run the reports and found that there really wouldn't be that much benefit to opening these up, and a client like this ran the reports and said, this is something that we feel is a good use of our time. How do we do it? And that's what we're here for. So between your account management team and your compliance team, we come up with a plan that works best for you and your employees.
Yeah, we should say that this was a success story, and that working with us, they were able, even with just two people in their HR and benefits department and a small FSA administrator, we worked very closely with them, kind of held their hand through the process, and it worked out very well. So that was a good one. Good situation. So Pam, you want to give us kind of the key takeaways here for today, and then we can maybe wrap up after that.
Yeah, let's talk about some takeaways. So with regard to your COBRA administrator, make sure you're communicating with your COBRA administrator or TPO that you're properly implementing the ARPA requirements for the subsidies notice. There are penalties for not complying with that. So important to make sure that you've let them know that which employees are involuntarily terminated and that they're sending out the notices. Speak with your COBRA administrator or FSA administrator or TPA to ensure that the proper administration of the outbreak period rules. And remember, these are individuals, so it will be different for each employee that goes through the system. And if you haven't yet implemented your FSA relief, we just gave you a few tips to try to narrow down your choices here. Review your FSA account balances, determine if the relief makes sense for your organization, and work with your corporate synergies account managers and FSA administrator to come up with an operationally functional plan. Speak with your account manager or corporate synergies to make sure your benefit plans as always are compliant, and that's where Dan and his team comes in.
Great, thanks, Pam. Yeah, I think it's one of the things that what really gives us an advantage in the marketplace is that even if you don't have the most experienced administrator out there, I mean, we have so many tools and resources for our clients that we can draft the right amendments, we can create the right dashboards, we can look at things from different perspectives, and I think that's something the clients really appreciate about what we do. So we've been a tremendous help in that area. And so finally, before we close for today, I just wanted to kind of point everyone to some really helpful resources, including our Compliance Resources Center page, which used to be called ACA Now. All of our alerts on these topics where you can find out more information are there, as well as updates on recent guidance that have come out explaining more of the information about this. And then also you can join us in our Health and Welfare Compliance Forum page on social media, or HAWK, as well as check out our future events. There's a link for that there as well. So thank you so much for joining us today. And thank you, Pam, for joining with me today. And I think this was really tremendous. Thank you.
Absolutely. My pleasure.